Every economics textbook teaches the money multiplier. The Federal Reserve prints reserves, banks lend them out, keep 10%, lend 90. That 90 gets deposited. The next bank keeps 9, lends 81. The cycle continues. $100 becomes $1,000. Clean, mechanical, predictable, except it's completely wrong. That system hasn't existed since March 2020, and it barely worked before then. But nobody updated the textbooks, and the consequences of teaching a dead system are destroying your financial future right now. Here's what actually happens. A bank doesn't wait for deposits to make loans. It creates the loan first. You walk in, ask for a mortgage. The bank checks your credit, approves you, then it types numbers into your account. New money, created instantly, not pulled from a vault, not borrowed from depositors, conjured from nothing. The deposit comes after the loan, not before. The textbook has it backwards. This isn't theory. It's confirmed by central banks themselves. The Bank of England published a paper in 2014 stating this explicitly. Banks do not act simply as intermediaries. They create deposits. The Bundesbank said the same. The Federal Reserve's own research acknowledges it. Yet intro economics courses still teach the multiplier model, as if reserves constrain lending, as if banks need your deposit to lend. They don't. They never did. And since March 2020, the illusion collapsed entirely. The Federal Reserve eliminated reserve requirements, 0%. Banks are required to hold nothing against deposits. The multiplier model taught in classrooms assumes a 10% reserve, but the actual requirement is 0. The model isn't just outdated, it describes a system that no longer exists. If you're studying economics right now, or if you learned this model years ago and still believe it, stay with me. Because what replaced it is far more dangerous. And understanding the difference determines whether you build wealth or watch it evaporate. So what constrains banks now? Not reserves. Capital requirements. Under Basel III rules, banks must hold equity against risky assets. If they make a $100 loan, they might need $8 of shareholder equity as a buffer. That's the new leash. But here's the problem. Capital requirements are risk-weighted. Mortgages are considered safe, so they require less capital. Government bonds require almost none. This creates incentives. Banks flood into assets the rules call safe, even when they're not. Remember 2008? Mortgages were considered low risk under Basel II. Banks loaded up, required minimal capital. Then housing prices fell, defaults surged, the safe assets weren't safe. The capital buffer evaporated, banks collapsed, the system nearly died. And the response? Basel III, slightly higher capital requirements, but still risk-weighted, still gameable. The structure that failed in 2008 remains in 2026, just with new labels. Here's the consequence you're living with right now. Since banks create money through lending and reserves don't constrain them, the money supply expands endlessly as long as borrowers exist. Every mortgage, every car loan, every credit card swipe creates new money, and that money dilutes every dollar you already hold. This is why your salary feels like it buys less every year. Not because you're bad with money, because the money supply grows faster than your income. Look at the numbers. In 2000, M2 money supply in the US was roughly 4.6 trillion. By 2020, it was 15.5 trillion. By 2024, over 21 trillion. Your wages didn't triple, but the money supply did. Every new dollar created through bank lending reduces the value of existing dollars. And because the textbook model is wrong, most people don't understand where the inflation comes from. They blame supply chains, or corporate greed, or government spending. Those contribute. But the primary driver is bank-created money, and it's invisible to anyone who learned the multiplier myth. The consequences compound. Housing becomes unaffordable because banks create mortgages freely. New money floods into real estate. Prices rise. First-time buyers get priced out. Homeowners feel wealthier, but that wealth is paper, built on debt. The moment lending slows, prices stall or crash. 2008 proved this. 2026 is proving it again. Yet the system continues because banks profit and the Fed enables. Inflation isn't an accident. It's structural. The system requires constant money creation to function. If banks stopped lending, the money supply would contract. Debt would become unpayable. Defaults would cascade. The economy would seize. So the Fed keeps rates low enough to encourage borrowing. And banks keep creating money, and your purchasing power keeps eroding. This is the consequence of a system nobody accurately teaches. Student debt illustrates this perfectly. Universities raise tuition, students borrow. Banks create the loans. New money enters the system. Tuition rises further. More borrowing, more money creation. The cycle feeds itself. And students graduate with debt that didn't exist before they signed the papers. Money created from nothing. But the obligation is real. The interest is real. The decades of repayment are real. All built on a system the textbooks call a multiplier. But it's not multiplication, it's creation. And the difference matters. Corporate debt follows the same pattern. Companies borrow to buy back shares. Banks create the loans. Stock prices rise. Executives get bonuses tied to stock performance. They borrow more. More money creation, more buybacks. Prices climb higher. Until they don't, and when the debt can't be serviced, defaults begin. The Fed steps in, cuts rates, buys bonds, props up the illusion. The cycle resets, and ordinary workers watch their savings lose value as asset prices inflate. This is why wealth inequality accelerates. The money multiplier myth teaches that banks lend existing money, intermediating between savers and borrowers. But reality is different. Banks create money for borrowers, new purchasing power. That money flows into assets, real estate, stocks, commodities. People who own assets get wealthier. People who earn wages fall behind because wages are sticky, negotiated slowly, adjusted annually, while asset prices respond to new money instantly. The system rewards debt, punishes saving. If you save in a bank account, inflation erodes value. 2% official, 5% real. Your savings shrink. But if you borrow to buy assets, inflation works for you. The debt stays fixed. The asset appreciates. You profit from the system's design. This isn't financial advice, it's structural observation. The money multiplier myth hides this dynamic, makes people think saving is safe. It's not. Not in a system built on endless money creation. And here's the darkest part. The people teaching the multiplier model know it's wrong. Central bank research is public. Academic papers confirm the reality. Yet curricula don't change. Why? Because the myth serves a purpose. It makes the system seem controllable, stable, predictable. If people understood that banks create money freely, constrained only by capital rules written in Basel, confidence might crack. And confidence is all the system has. The textbook model implies the Fed controls money supply. It doesn't. It influences it. Through interest rates, through reserve levels. But banks decide how much to lend, and borrowers decide how much to take. The Fed can't force lending. It can only make it cheaper or more expensive. When rates are low, borrowing increases. Money creation accelerates. Inflation follows. When rates rise, lending slows. Money creation declines. Recession threatens. The Fed doesn't control the machine. It nudges it, desperately hoping the nudges work. This explains why monetary policy feels broken in 2026. The Fed raised rates to fight inflation. But inflation persists. Why? Because bank lending continues. Money creation continues. The multiplier model suggests higher rates would restrict lending by reducing reserves, but reserves don't matter anymore. Capital requirements matter, and those are set globally, by Basel, not by Congress, not by voters, by technocrats in Switzerland. The control mechanism taught in textbooks doesn't exist. The real mechanism is opaque and unaccountable. The consequences extend beyond inflation. The entire concept of savings becomes obsolete. If money is constantly created through lending, holding cash guarantees loss. You must chase yield, take risk, buy assets, participate in the debt machine, or fall behind. This isn't choice, it's coercion by design. The system punishes those who opt out and rewards those who leverage. Retirement planning becomes impossible under these conditions. Traditional advice says save consistently. Compound interest grows wealth. But compounding assumes stable money. When the money supply inflates constantly, compounding barely keeps pace. A dollar saved in 2000 lost 70% of its purchasing power by 2024. Compounding at 5% annually didn't overcome that. The system ate the gains, and textbooks still teach compound interest as magic. It's not. Not when money creation outpaces returns. This is why every generation feels poorer than the last. Despite technology improving, despite productivity rising, the gains get absorbed by money creation. New dollars flow to asset holders, to borrowers, to banks collecting interest on money they created. Wages lag, savings erode, and people wonder why working harder buys less. The multiplier myth obscures the answer, makes it seem like personal failure. It's not, it's structural extraction. Now ask what happens when this breaks, when borrowers can't service debt, when defaults cascade, when banks stop lending because capital buffers are exhausted. The money creation stops, the supply contracts, deflation begins, not the good kind from productivity, the bad kind from collapse. Debt becomes unpayable. Defaults accelerate, banks fail, the Fed prints reserves, buys assets, tries to restart lending. But if borrowers won't borrow, new money doesn't get created. The machine seizes. This is the deflationary spiral, and it's the system's true nightmare. The multiplier model can't explain this because it assumes reserves drive lending. Just print more reserves. Problem solved. But reserves don't create money, loans do, and loans require willing borrowers. If confidence breaks, borrowing stops. No amount of reserves fixes that. The Fed learned this in 2008, printed trillions, handed reserves to banks, lending barely recovered. Because the model was wrong, and policy based on wrong models fails. If this changed how you see money, share it. Because the system depends on confusion. On myths taught as fact, on models that died but never got buried. The multiplier is dead. Understanding what replaced it is the only way to navigate what's coming. And what's coming is the bill for decades of money created from nothing, with interest compounding on promises that were never real.